Confused about financial advisor fees? A lot of people are. Learn how much you should be paying for your financial advice. Then, did you know that your behavior can negatively impact the rate of return? Find out how. And tips to help give your family members a leg up. All this and more on The Wealthy Life. How much do you think you should pay for financial advice?
Probably a percentage would sound more fair. Yes.
I think a flat fee makes a lot more sense, because I think a lot of people enter into contracts and they don't understand how much just the manager is taking.
I'd base it on a percentage of what my return is on that investment.
Today's guest is John, a retired naval officer looking to get better portfolio performance. John, welcome to the show.
Well, thank you, Sybil, and I'm sorry, I just have to correct you. I'm a Chief Petty Officer, retired.
A Chief Petty Officer?
Yes,
well, thanks for the correction.
Yes.
Tell me about your background.
Well, I'm originally from Belleville, Ontario, and my father was a veteran of the Atlantic, Battle of the Atlantic. And then we had the family business, which was a kind of a rough and tumble hotel and bar that he owned and operated for 40 years along with my mother.
Were there some good stories along the way in there?
Well, he used to say if he came home wearing the same shirt he went to work with, it was a quiet night.
Did you ever have to get involved? Did you act as bouncer once in a while?
Well, no, I certainly learned a lot of life lessons as I was a teenager working behind the bar with him, and then I went back in the 20s, and in my 20s, and I can tell you that I learned a lot on the floor of that bar. I can tell you that right now.
Oh, I bet. Now, is it true? Does everyone pour their soul to the bartender?
Well, I've heard certainly lots of stories, but we're talking about the days where they used to sell beer by the trayful. And so, yeah, lots of stories and lots of arguments.
So how did you transition from the family business into the Navy?
Well, the family business sort of, like the family farms, all of a sudden it wasn't as profitable as it was, and my father and mother decided to sell the business. So that left me to decide now to go in a different direction and anywhere I wanted to go.
What do you want to be when you grow up, kind of question?
Well, you know, I listened to sea stories, and I was always interested in the armed forces and serving my country, so that gave me the opportunity to do that.
And how many years have you done that?
I just finished a 30-year career. And,
wow.
and so I'm just starting in my time in retirement.
Now, would you say you had equally as interesting stories in the Navy as you did in the bar business?
Well, a lot of those bar stories help through what they call the back watches, when you work from midnight to 7 in the morning. So I was able to tell a few of those stories, but I will never be short of stories for the rest of my life between the bar and my time at sea.
Well, and now you're just beginning retirement, and you've got a whole bunch of new stories to make as you live the rest of your life, which is many years ahead, I hope.
Well, that's correct.
What does retirement look like to you?
Well, today I had a cup of coffee. I watched a show called The View, which I've never seen before. It was quite comical. I went for a run. I gave blood, and now I'm here.
Wow, okay, so this is quite a day. Is every day going to be this exciting?
Well, I don't think it'll be this exciting, believe me. No, but.
What do you think realistically over the next 20, 30 years, what does that look like for you?
Well, you know, I want to continue to work. Yeah. I want to be able to utilize the skills that I learned in the Navy, both in leadership and organization. And I think overall I want to be a good citizen, you know, and be able to have a job that's going to fund our fun a little bit, take care of some obligations that I still have, and stay healthy.
I love that. I think everybody needs to continue to have purpose throughout retirement, and a lot of people struggle with the transition from working to not working, because how do you fill your days? Although yours sound pretty darn good off the get-go.
Well, I think I could do without The View, but other than that,
yeah,
it would be fine.
You may have to find a different show to watch. I know a really good one called The Wealthy Life.
Yeah, I tune into that often.
So John, what's your big question for me today?
Well, my question is, how much should I be paying in fees for financial advice?
Great question, and it's one everybody should ask. So don't go away. Find out if you're paying too much or not enough for financial advice after the break.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
Welcome back. We're here with John to learn what fees he should be paying for managing his portfolio. John, it's such a great question, and there's not a one-size-fits-all answer. I think you were hoping I had a better answer than that.
Well, I was hoping, but
we will get to
Yeah.
it. It's like buying a car. It'd be like saying, how much does it cost to buy a car? Well, it depends what kind of car you want. You could go for a used, beat-up, 20-year-old beater that may cost you $1,500. It gets you from A to B. Or you may buy the top-of-the-line Tesla or whatever your taste is and spend $150,000 on that car. When it comes to fees, there's different types of fees you can pay for financial advice. So let me start with basically a commission type of account. A commission type of an account is where you as a client will just pay a commission every time you buy or sell a stock. What experience have you had in the past? Were you a commission-based or a fee-based investor?
well, it'd be commission-based, be a combination of stocks and mutual funds.
Okay. Perfect. So I'll explain both of those.
Right.
So on the stocks, if your advisor would phone you up to recommend I buy ABC stock,
Correct.
You'd say go ahead, and you'd get a slip in the mail and it would say you paid this much in commissions.
Correct.
Same thing when you go to sell. Now, the commission style fee base is great for buy and hold type of portfolios. And an example would be, I see people who maybe inherited some shares or own shares of Royal Bank of Canada, and they've owned them for many, many, many years. And if they were to sell it, there'd be a huge capital gain. And it fits in their portfolio, so they just want to continue holding it for many years to come. Paying an annual fee to hold that stock would be expensive. So a commission-based account would probably be better. Now, sometimes when you get active trading, the commissions on every transaction start adding up.
Correct.
So that's where a fee-based account may be better. A fee-based account is where you pay a set fee per year for the portfolio manager to run your portfolio, or the financial advisor to give you advice. And you can do as many trades as you want in most cases. There's sometimes certain limitations. Now, fees on a fee-based account range anywhere from a low of usually around 0.8 to 1% of the value of your portfolio, all the way up to 2.5 or 3% in some of the mutual funds. Now, the mutual funds you own, you're paying fees on those. Did you know that?
Yes, I did. Yeah.
Most of those fees are embedded. Some of it is now disclosed,
Correct.
A certain portion of it. But overall, you're paying somewhere in the neighborhood of maybe 1.5 to 2.5% in fees on your mutual fund. Now, fees are okay as long as you're getting value.
Well, that's why I'm here to ask that question.
So what do you think is a realistic rate of return to get on your portfolio?
Well, in today's world, I would think anywhere from 3 or 4% would be fine with me.
Well, that's a very reasonable, realistic target, and actually that's from a more conservative, lower risk portfolio. On a scale of 1 to 10, 1 being low, 10 being high, where would you rate yourself as risk?
Certainly in the middle, or even up to this point, probably towards the high end. And so maybe I think that's what's got me into a little bit of trouble.
So typically more of a balanced, diversified portfolio, historically long-term averages after fees has been more like 5 to 7% per year. So if you haven't gotten that thus far,
Correct.
it's maybe time for a second opinion, which you can move forward and do.
Right.
The key thing is you want to understand what your risk profile is and focus on the after fee performance.
Correct.
One other point I want to leave you with. Managing the portfolio is only one piece of the fees that you're paying. There's a list of questions that you should ask your financial advisor to make sure you're truly getting the value for the fees you're paying. Are you getting a financial plan? Are you getting tax saving strategies? How about estate planning strategies. All of those things make a big difference on the bottom line and the money that's going to be in your pocket and your true rate of return. For a list of questions to ask your financial advisor to make sure you're getting value for the fees you're paying, contact us at thewealthylife.com. And John, thanks so much for being on the show today.
No, thank you very much.
Stay tuned. Learn how investor behavior can negatively impact your rate of return.
The Wealthy Life is brought to you by investment dealer Raymond James. Life well planned. See what a Raymond James advisor can do for you.
With us today is Shamez Kassam, financial advisor and author of Your Money's Worth, the essential guide to financial advice for Canadians. Shamez, welcome to the show.
I'm so pleased to be here. Thanks for having me.
Well, this book feels like it's got some substance to it. It's heavy.
Yes, it does. It's been about a 2.5-year project or so, and it just came out this March, and so I'm really excited about that.
Fantastic. Now, what inspired you to write this?
Well, I've been quite fortunate just to have a broad range of experience in the financial industry, and so I spent the first part of my career working with some of the largest institutional investors across North America, and then I've been working with individual investors since about 2009, and it was really when I started to work with those individual investors that I noticed two things.
Yeah.
One was that our industry is so confusing, unfortunately, from the consumer's perspective when it comes to
big words.
Yeah, we do.
Talk
Yeah.
sometimes too much and above people's head.
Yeah, there's that, and also when it comes to trying to find an advisor, there are so many different types of advisors with different letters behind their names, different qualifications, and in my book I refer to that as advisor alphabet soup, in fact, right?
Okay.
And
Yeah,
so
what does that all that mean? CFP,
Right, exactly.
CFA, CIM, FCSI, I mean there's a million of them.
Yeah. And so I spend the first part of the book just giving an overview to the consumer just about the financial advice industry in Canada. What types of platforms are available? What kinds of things should you ask when you're interviewing an advisor to find one, and that kind of thing, right?
So really you're setting the stage at the beginning so people understand that not all financial advisors are created equal.
That's exactly right.
And you provide some questions that people can ask so that they find the right fit for them.
Right, exactly.
Now,
yeah.
I know that financial literacy in Canada is not anywhere near where we would like it to be or where it should be, and investors often make mistakes.
Yeah.
What are some of the biases you think people have when it comes to investing?
Well, and that's an interesting question, because that's the other thing that really inspired me to write the book, because I noticed that investors were making common mistakes, and most of these people are very well educated in their own field and they're professionals, but unfortunately our schools don't do a great job of teaching basic personal finance. And
It's
so
either that or
yeah.
maybe the kids just aren't paying attention, because I've got a teenage boy.
Yeah.
So he's at school, he's learning a little bit here and there,
Yeah.
but I almost feel like the school system expects the parents to teach a bit more, and the parents expect the kids to teach a bit more, and at the end of the day, the blind is leading the blind, I feel.
That's where it ends up usually, and so some of those common mistakes I find, so things like, for example, taking too much risk, for example, not being diversified enough, and then in terms of biases, you know, there's one bias I think that is really important, and that's called recency bias. So short-term memories and short-term experiences are often more powerful than long-term long-term experiences and long-term memories. And so, for example, right, when the market is doing well,
Yes.
on the upside, you know, most people get too aggressive and they get greedy. It's only natural, right?
Yep.
And they and then oftentimes they will buy near the top, and then conversely, when markets are not doing well, you know, and they see their portfolio values drop every day, then
Yes.
then at some point they will panic, right? And so these are some of, you know, that's
that's a
one
common
example.
one.
Yeah, it is. You know, but you see it all the time.
So what can people do about it? How do they avoid making that mistake that people seem to make time and time again?
Well, I think there's three things that investors need to do, right? One is educate, educate, educate. And that's actually three things in one, I guess. But, you know, nobody cares about your money as much as you do. Yeah. So take the time to just educate yourself, right? Understand the basics. That's what my book's all about. And then the next thing, from an investment perspective, is make sure you know what your own financial goals and objectives are, and what your personal risk tolerance is, right? Oftentimes people compare, you know, their investment returns to this benchmark or that benchmark.
Or their neighbor.
Right, exactly.
And their
right?
neighbor only tells them about all the things they made money on. They never tell about
Exactly,
the losers.
right? You know, and you know, but what's most important is what amount of risk do you need to take to achieve your goals and objectives, and just know what that is, and then have a plan that is based on that from an investment perspective, and a plan you can stick with.
Now, it sounds so easy, and we hear this time and time again, and it's a recurring theme even throughout this show, yet people still aren't listening. And I don't know if it's because they find finance harder to execute on than it sounds, but it's not. It's have a plan and stick to it. Do you think that, can some investors do it themselves?
I think absolutely they can, but there's a big if with that, right? If you have the right knowledge and you have the discipline, and most importantly, if you have the ability to keep your emotions under control, then you can be successful.
Okay,
But
so for
not
people
all
of the
have that.
knowledge and the discipline
Yep.
and the experience, they can do it themselves.
And the emotional control.
Yeah.
You know, I will say though that a lot of the value add from an advisor is it's in other areas as well. So in the book, I refer to a concept of making sure that all the rooms in your financial house are in order, right?
I like that.
The investments is one room, but then there's also insurance, right? Do you have enough insurance? Do you have an estate plan? Do you have a retirement plan? That's really where a lot of advisors do add a lot of value. And unfortunately, most consumers, they just focus on the investments, but I do touch on all of those things in the book, and that's really why, you know, I think it's a must read.
Well, that's great. Is there some final tips you have for investors today?
You know, just going back to what I said earlier, is just know your risk tolerance, and then have a plan that you can stick with in good times and bad.
Well, I think for those of our viewers who have no idea what their risk tolerance level is, we have a risk profile questionnaire. Contact us at thewealthylife.com for your questionnaire to find out where you fit on the scale of risk, because that'll make a big difference in building the right portfolio that you can ride through.
Yep, it sure will.
Shamez, thank you for being on the show today.
Thank you. It's been my pleasure.
When we return, how to help your grandkids get a leg up financially. Welcome back. Thanks for your letters, emails, tweets, and messages. Today's question is from Cheryl in Calgary. Hi, Sybil. I am 67 years old and my husband is 72, and between us we have 6 grandkids ranging in age from 3 months to 12 years old, and are now in a position to save money for them either for education or down payment for a home or ? We want to give them a leg up in life when they turn 19. Any ideas would be greatly appreciated. Thank you, Cheryl. Cheryl, it's great to hear you're wanting to help your grandkids. I don't think kids have a very good financial position today, and so for you to be able to help them out is going to make a huge difference. 2 big ways that you can help them. Number 1, you could set up a trust account and fund the trust account with whatever amount of money you want. The trust account can either be formal, through a lawyer, fees apply, or informal through your financial institution. But the biggest way that I'm recommending you help your grandkids is through an RESP, Registered Education Savings Plan. For every dollar you put in, the government is going to deposit 20% of that in the form of a grant. It's like getting 20% return on your money. Of course, maximums do apply. That grant is capped out at $500 per year and $7,200 over the lifetime of the RESP. The maximum amount of contributions you can make is $50,000 per grandkid. You can invest that money however you like, and any interest, dividend, or capital gains earned on that money while in the plan grows tax-free. At the end of the day, when they go to withdraw the money from the plan, all of your deposits are withdrawn tax-free, and any growth and grant money is taxed in the hands of the grandkids. And likely they will have little or no tax to pay at that point in time. So go for the RESP, see your financial advisor for more information. And that wraps up this edition of The Wealthy Life, helping Canadians make smart financial decisions. Join the conversation on social media and tell us your story. Go to thewealthylife.com to ask your financial question to make the most out of what you have.